Hello and welcome back to today's Personal Finance Show here on Dublin City FM with me, Paul Merriman from askpaul.ie, and our new sponsor, which is Avant Money. I'm actually joined in studio by Brian Land from Avant. Brian, you're very welcome to the studio.
Thank you, Bob.
And first of all, thanks very much for sponsoring the Personal Finance Show here on Dublin City FM.
It's great. The advice that you provide to thousands of people aligns to what we're trying to do, is educate people.
I really appreciate it. I'm really looking forward to this as well. Brian, you were in the studios before. We spoke about some innovative products you guys had at the time. We've had more products out, which we'll talk about in a second. Probably the big one for consumers listening to the show today is, if we don't want to be jumping into this, interest rates and Trump, and what you think might happen. Before you came into the studio, top of this show today, we did speak about Trump. We talked about the market volatilities, what we are expecting from a personal finance point of view. But yeah, do you mind bringing listeners on what your thoughts are?
It's been a roller coaster of a week, hasn't it?
It has, yeah.
And we saw Trump's announcement, we saw markets go crazy, and we saw the cost of borrowing money, interest rates start to fall more sharply.
Yeah,
we saw some of the other analysts predict even more rate reductions than is already predicted.
Now, that's just for this, for listeners, can we explain, I kind of did this already top of the show about the bond yields. So bond yields actually going up, and pretty much because the countries he slapped tariffs on basically dropped their bonds, which drove the price up. But that's in relation to the Fed. Do you think it's going to really have an impact with the European Central Bank? Because can we drop much lower? Like if the EU is trying to get inflation to 2.5%, if tariffs kick off, can you see, if it's 2.5% inflation, I would have always thought you need your base lending to be 3% to keep inflation down. And the European Central Bank has a different role than the Fed. Now, the European Central Bank is terrified about inflation only, where the Fed has to keep an eye on economic policy and inflation.
I suppose what you've seen happen is pre-Trump, let's even go back one step. The prediction was we'd see 2 more rate changes this year. We'd see another 0.5% come off the ECB. And that would have brought the ECB rate to around about 2%. And that's what pretty much all the analysts and the consensus was for this year. That would allow mortgage rates to probably sit around 3%, which would be a more normalised level, I would suggest, right? Maybe a little bit over 3%. We're now in uncharted territories. We really don't know what's going to happen one day to the next with the US policies. And I suppose we saw that almost instantly in terms of how deep the crash was on stocks and shares in the UK, or the US rather. And we also saw interest rate predictions start to grow in terms of how fast they would fall. And, you had JP Morgan Chase, for example, earlier this week saying 4 changes this year in Europe and in the Fed. And I suppose we'll wait and see what will come through. I suspect we'll go back to 2 changes this year, I think we'll see one, very quickly.
I think that one might be quarter though. Do you think, or think it's going to be a half? Would you back a half?
No, I think a quarter.
Yeah, I think a quarter.
I think it's what. And the question is when the second quarter arrives. The first quarter is very, very soon. Yeah. And the second quarter is either before you see or in the early autumn.
I think it might be. I would be backing for it to be later in the year, and the back of the ECB, just being cautious and seeing what happens. Because if this tariff thing does kick off, especially with China, as in if it does, if he doesn't back down, it's like a game of chicken. Yeah. But if he doesn't back down, we might find ourselves in a situation where you might see inflation start to creep up, and that's when the European Central Bank will attack.
And so that's good news for mortgage holders.
Yep.
Maybe not so good news for savers. So everything is a yin and a yang, basically.
Yes.
And I suppose for our customers in the mortgage world, we've a great product we've just launched, which will automatically adjust as those rates come down.
Yeah, so we get into that because tell you what my voice is being to clients, and we're getting a lot of clients in. And everyone's nervous about interest rates. I think for the last 10 years, because interest rates were so long up to 2022, I think there's nearly been a sense of, this is just kind of free money and money's cheap. But I think people have experienced a lot of turbulence in interest rates since 2022, since inflation increased. And now we're finding that customers are looking for more stability. So I will say, not just because you're a spot, I think anyone that's listening to this show will have probably sick of me saying this, but I think the one mortgage product at the 3.4% is still one of the best products in the marketplace. And if I was going for a mortgage or needed a mortgage, I'd be picking that up. And even if, you might say in 6 months' time, you might pick it up for maybe 3.2 if interest rates fall again, even maybe 3% in a year's time if all goes well with interest rates and inflation. But it's not guaranteed again to stay at 3%. If you're on a 30-year mortgage, the likelihood of that staying at, it's definitely not going to get lower, because unless it's another economic disaster and we're printing money again, which hopefully won't be the case. But it can go anywhere between 3 and 4.5% over the next 30 years. So I still think a 3.4% lock-in offers a lot of security, and from a financial planning point of view, it is a kind of no-brainer. When you look at the interest rates that are out there, with variable rates and even other banks being so much more expensive and offering only 7-year or 10-year fixed rates. Right, I think like that's the product for me. But let's talk about the new Flexi product, because that's the one you're mentioning. It is linked to the Euribor, which will fall. The Euribor isn't linked to the ECB though, so
it closely. It does tie to
what would be spot? It wouldn't go up and down as quickly, or it wouldn't pass on the rates as quick, would it?
No, it's actually the opposite way around. So generally, the market will try and drive what they think is going to happen. So you say Euribor go a little bit earlier, and you see that now. They kind of anticipate rate changes, and they do on the other side as well. If rates were to rise, they'll be anticipating that a little bit.
Because we did cover on the show with Shane Cullen, head of mortgages in Fairstone, Ask Paul a few weeks ago, in relation to the Flexi products. I was saying how good it was, and I think it's perfect for people that might have. Actually, you might explain it for us, listeners.
Okay,
well, let's go through it.
If you think about it first, we can actually offer something to everyone.
Yeah,
we can give you that pure variable product in Flex Mortgage, and we can give you that pure fixed product effectively in our One Mortgage, and we're the only lender that can do all of that.
Yeah.
So if you're of the mind that says, I want security, I want certainty of payment, 3.4%, and I know that's going to be fixed for the life of my mortgage, brilliant, we've got that.
So let's call that a really low risk kind of person that just wants,
exactly,
doesn't ever want to hear from the bank again, wants to know they're paying X amount for the next 30 years, 20 years, whatever's left on the mortgage.
Yeah, and look, I mean, those customers, if they look back 30 years, you're absolutely right. The last decade after the financial crash was an extraordinary period.
Yeah.
Well, extraordinary times, like post-war or something, right?
It's 100 years of it.
So it's 100 years of it. Over the last 30 years, rates have averaged about 5.2%. So if you can buy...
Over the last what many years, sorry?
Over the last 30 years.
30
so
years.
Mortgage rates have averaged about 5.2%. So if you can buy that product now and fix for 30 years at 3.4%.
Oh, Brent,
the odds are you're going to beat the average.
Yeah, I think I've said this all the time. Yeah.
So I think it's a great product. And we sold this product a couple of years ago for 2.25, and I still have friends who thank me for it.
I get the same, yeah. And I had the other 2.2 product, yeah. And 1.9 was in the market. But again, I think we were screaming at people to switch.
This is great.
And everyone thought we were mad. We were just trying to scare people when interest rates were going up. They're obviously cyclical.
If we go to the other end, the Flex Mortgage way. So the Flex Mortgage, and we were asked all the time, is it a tracker? It's not a tracker. It's better than the tracker is why.
But it tracks a rate.
It tracks a rate.
So that's where the confusion
elements of it. So it's a variable rate.
Yeah.
And the beauty of the variable rate today is 3.30% or 3.50%, depending on your loan to value.
Yeah.
And the beauty of that as a variable rate is that's at least 0.5% cheaper than everybody else in the market. And to put that in context, for a borrower on a 300,000 mortgage, no matter what LTV they're on, first time buyer at 90% or a switcher at 60%, they're saving on €110 every month, or 40,000 on your typical mortgage. So if you're sitting there on a variable rate with anyone, you should be looking at this.
100%. Yeah.
And you should be talking to your broker, and we've a very select few brokers, Ask Paul being one of them, who have this product, or you can talk to us directly, and we'll guide you as to what you need to do.
Yeah, I think the good thing there is that when you mention the variable product, I still come across customers that, and I don't understand it, but they are, what's the word I'm looking for? It kind of, I can't say lazy because I don't want to be disrespectful to anybody, but they've come off a tracker, they're still in the variable rate maybe, or off a fixed rate, they're hanging around with variable rates of 4.2 or 5%. And the kind of language they're using, they're just, it's too much work. And when you explain in a mortgage calculator that you're going to say 40 grand or 120 grand in interest or whatever the figures are, they get blown away because they just don't understand the impact of that 0.5% you're talking about, because it doesn't sound like much.
It does.
And the time, energy they're thinking, and it's just, it's really frustrating. And I think it varies to you guys as well. You've made that mortgage journey a little bit quicker, underwriting's a bit quicker and slicker as well. I think the pillar banks. But yeah, I think that 0.5% is a really good kind of point to put out there. 0.5% difference in your mortgage, 300k mortgage is going to be about, what, 40k? Yeah, and that's based on 25-year term, I think.
25, 30 year
term. So 30-year term, and then so if you have a 500 grand, 600 grand mortgage, it's double miles in the difference. Sorry, if you have a 200 grand mortgage or a 100 grand mortgage, is still, 10 to 20 grand in your back pocket rather than the banks. And what we do at Ask Paul at Fairstone is trying to show clients, even if you don't, let's say it's the 110 a month, it's trying to recycle that 110 a month maybe into a pension and getting tax relief on it. So it's trying to use two financial products together, which means it's not costing the client money to fund their pension. And you could obviously save yourself the interest, but then with interest, from tax, and interest growth on your pension, that could make nearly 100 grand difference maybe in the pension pot. So they're massive figures with just 0.5%.
And it's not difficult.
No, it's not. It's not
really simple to change your electricity overnight.
Yeah.
But it's not that difficult to change your mortgage.
But in fairness, change electricity overnight, still a lot of people don't do it.
No, exactly.
Because they just feel fearful of it. But that should be, an overnight thing, because it's 40 quid. We're talking about 40 grand.
Exactly.
And someone lending you 300k in that example. It's not the same thing as the energy prices. But I take the point of trying to transfer them. Go ahead.
But to come back to the flex mortgage. So what the flex mortgage gives you is it gives you that benefit of a variable rate. So the beauty of it is you get a very low rate. You can exit the product anytime you want. So it suits those people, for example, who are going to trade up next year, or going to maybe want to make a big overpayment, a big bonus coming. You also get it referenced to a benchmark rate. So the beauty of our product, and it's unique in the market now, is that every time that benchmark changes, you're going to get the benefit automatically. You're not waiting for the bank to decide. You're going to get it.
Yeah.
That's unique, right? And the final bit that we've put into that product is the effectively a bit of a fixed rate element to it. So we allow a 1 year period while we change the rate every year.
So the tracker is the tracker element is being tracked for a year.
A year.
Yeah, and then that means in a year's time, you can decide if the rate goes up and you want to jump into a fixed rate, you're going to let them.
You can do that.
And that's really where that flexy part of this comes into consideration.
Exactly, yeah, exactly.
So you're going to beat the variable rate, you're going to have a flexible product, you can move in without too much hassle into a fixed rate as well, and into a very, very good long-term fixed rate if you want, like the one mortgage product.
Yeah.
So you can flick back into that.
And look, Paul, this is the common product in Europe. Right. That's like the beauty of this, right? Not that we're some very clever people here in Ireland. We've actually just looked at what's available through our parent organisation in Bank Inter in Spain, and we've taken the best of the products in Europe and brought it to the Irish consumer for the first time.
And you know what? I was actually thinking about this because I said this to somebody only a few weeks ago. I remember doing a video in Spain back probably 6-7 years ago. And the Ask Paul page kind of had blown up on the back of it. It was actually on Snapchat and Facebook at the time when they were the most popular social media outlets. And I was outside Santander Bank in Madrid, and I was talking about how first-time buyers could fix at 1.5% fixed for up to the 30-year or 25-year term. And at the time in Ireland, their average was about 3.2%, I think. And I was just saying how ripped you were getting. But also, on the Ask Paul page, we always get people saying, can I get a mortgage from a Spanish bank or a French bank or a lender in Spain or a lender in Europe because they're much cheaper? Well, I don't think it's ever going to happen as in that free move, because from a legal point of view it's difficult to do. But just to remind people, you're a part of the bank and tier, that Spanish bank, and you now operate in Ireland as bank and tier as well. So I think it's great because that goes back to my video 7 years ago that we're now seeing a Spanish bank in Ireland competing and bringing those type of normal products that you see across the EU into the Irish banking system or the Irish customer for banking, which is great.
Yeah. We brought the bank here, basically. And we proved the concept here with our team in Ireland.
Yeah.
And it's gone very well for us. And the bank has seen the opportunity to come and do more products here. And we'll see more products in the future. Right now we do obviously credit cards, personal loans.
I love the way you're biting your lip there because you can't tell me what they are.
Can't tell you what they are.
Very fair, back in studio.
The next thing, as you know, has been fairly public, is that we will bring deposits to the market. And beyond that, we'll wait and see. But there's a big ambition, I'm sure. No,
there is a big ambition from banking here, but I think it is great. The main point is that we're getting the access, and your point is that these are common products everywhere across the EU, and we've just been not giving them with the Irish banks.
No, and we've what's common in the EU is that the rates track a benchmark. So the consumer is always protected by a fixed margin over that benchmark.
Yeah.
What's unique about Ireland and the UK is the notion that the bank sets the rate however it wants. And I suppose, we've really called out that transparency gap, and we've tried to address that.
And especially with the variable rates, because the variable rates have been absolutely crucified since inflation went up in 2022 and passed on to the consumers at alarming rates, in my opinion. And then they're not necessarily passing the cuts on quickly enough as well. So you're right, the bank is just picking, the product that suits.
If you go back to the decade you talked about after the financial crash, when funding costs were negative.
Yeah, they went past negative rates on you.
You were paying 4.5% with other banks.
Which, look, don't get me started with Irish Bank, because you'll be here for the whole weekend.
Yeah.
But, you know, from a deposit point of view, one of the biggest things, and I know we do give the banks a hard time, and it's not over competition, because I don't think that a bank is competition to us in Fairstone as Paul, because they're just tied agents, they're life companies. It's not good advice, in my opinion, to be a tied agent or getting advice off a tied agent. I've always said that. But the problem for me with the banks is not passing that deposit rate on over the last number of years and inflation to people. 160 billion just sitting there, practically overnight, getting 0%. Well, the bank is picking up 3, or has picked up 3, maybe 3.5% in 2023 and 4. Just in the bank is sitting in the EU, sitting in the ECB rather, and not passing that rate over to consumers, I think, has been the biggest, you know, issue with banks, especially considering most of those consumers are probably still paying from austerity measures of bailing the banks out in 2008. Yeah. So it's nearly, you wouldn't see it in the episode of The Simpsons, you wouldn't get away with it, I don't think. Anyway, that's my rant over in relation to the Irish Bank, because I do think it's great, not just because you're sponsoring the show now. I said this when you guys were in studio before. I think what Avant Money has done for the Irish consumer is absolutely phenomenal in relation to choice and driving competition. And especially since I know you guys are here at 20 odd years, 28 years, and you're in the mortgage market about five. But, you know, even with KBC and Ulster Bank leaving, like, they were actually quite good competitively over the last 20 years to keep Irish banks on their toes, and they used to drive those rate cuts, and they used to bring competition into the marketplace. So, yeah, look, I think it's brilliant what's being achieved, and a long way at last. I'm really looking forward to the next round of products.
Yeah, we're
in relation to the flex product as well, you know, we would talk about how good the fixed rates are, the one mortgage product and having security, but that flex mortgage is really good for people that might be thinking of overpaying more, because your product allows you to overpay 10% penalty free on fixed rates anyway.
Yeah.
So obviously with the flexi, you can just clear the thing any time without any overpayments.
Win the lottery, hopefully, and then pay it off would be ideal.
Just get a really good financial planner to help. But sorry, talk to me then in relation to the flex mortgage, because I've had more experience personally with customers that are looking for the 3.4% and people that are coming off variable rates. So I presume you're seeing customers that are people that might be due inheritance, due lump sum come from somewhere, selling businesses.
We've seen, it's very early days. It's only been available for about the last week. And I think we've seen a lot, almost instant demand on our website and through our call centres and through our brokers. And I think we see different types of customers. So we see customers who are brand new, starting their mortgage journey, saying, actually, I like the idea of this. I like the idea that rates are likely to drop, and therefore I'm going to take this product. We also see some customers who are about to draw somewhere else and saying, hold on a second, actually I didn't have this option when I was applying for my mortgage. And we're more than happy to help those customers. Yeah. They're not stuck with the product.
That's a really good point, actually, because I think what a lot of people don't realise that once you get your loan offer, or, you know, you don't have to pick whether you're going one mortgage or flexi until you actually are drawing down. So exactly. If you're someone that's thinking, well, I'm going to be in a fixed rate, I've picked a decent fixed rate, or you're in that one mortgage product, you can just decide before you draw down, actually I'm going to go flexi because I think rates are going to fall. I think I might get back into the one mortgage product next year at 3.2 versus 3.4.
Keep your options open as long as you can, basically, but don't leave it too tight, right? Don't try to change them on the day of the drawdown. And but definitely you keep your options open.
Yeah, and again, I think it would suit, from our point of view, as somebody that has a really good, honestly, financial plan in the background, or know they're getting maybe their inheritance, or even if it was a redundancy payment, or something was going to change in their life that allowed them to pay more than that 10%, is when you want that flexibility, because you genuinely think the one mortgage product has the flexibility of 10% a year. So a lot of people can stay cash rich, pay down 10% a year, and still be in a phenomenal situation in 10 years, if that's what they wanted.
One of the things that struck us, it was a brand new product to the country, and we were very conscious that people would take time to understand it. What's amazed us is how quickly people have actually understood it, and everyone sees their own benefit from it. For some people, it is that idea, I can pay it off quickly, I can overpay as much as I want, I have all that flexibility. For some people, they like the fact that it's transparent, that it's going to match the market.
There's also a lot of people out there that don't want to be wrong and fix and find the rate. It will kill them to sleep. They won't be comfortable sleeping for the next 20 years knowing that they fell to 3.2, whatever it is. And I come across those type of clients all the time where they're kind of worried about what rate their neighbour got and what they got, and it will actually stress them out to think that they fix for too long at too high of a price. So I can see where that psychologically will give them another year or whatever. Can you switch it actually between now and the year rate? So just if
you can, you can switch
so
it.
you felt, yeah.
So if go back to Mr. Trump, if something dramatic happened, you can just ring us up and we'll switch you to it.
Because your rates tracked for the year. So if rates went the other way today, you've still got 12 or 11 months to actually switch out and go into a fixed rate if you wanted.
So if you happen to draw down this product today, it's 3.3.
Actually,
it's 3.3 for the next year.
Yeah, that's right. So if anything does, it's a lot of time. Yeah, there is to think about, isn't there? Really,
you're not locked in at the end of that year. You can do whatever you want.
So you can do it at the end of the year before the rate changes.
Earlier if you wish.
Yeah.
So it is what it is. It's flexible in every way.
Yeah, I never thought of that piece actually. Like you're kind of knowing where rates are.
Yeah.
3, 4, 6 months out from when you actually are making the real decision on whether to stay or stick.
Look,
stick or go.
For someone starting their mortgage journey, if you go there, like, why lock yourself into one choice at the start? When you're out looking for a house, it'll take you 6 or 12 months to find that house. Life can change in the meantime. Have all the options.
Yeah.
We're happy to facilitate. You can pick one product with us and change your mind.
Yeah.
No,
you're right, yeah. No, I think it's sorry. Big thing here is that what I look at from being a financial planner, and we've obviously run a very successful mortgage department here at askpaul.ie Fairstone. But giving clients choice is the best thing we can do. Because it's brilliant, and you can have really meaningful conversations with clients, and building in these type of products into a financial plan where there's other things going on, like whether it's pensions or investments and savings and all your things in the markets. And you mentioned this earlier on about being good for mortgages but maybe bad for savings. So there's so much noise out there at the moment that having more financial products and more, especially for mortgages, and more options for clients makes for a much more interesting, in my opinion, case with clients. And they really appreciate then the value of the service and the value of the professionals that we're bringing, because we've way more products than them just walking into a high street bank and getting stuck with one bank, one product and one option,
I've said this any number of times, Paul. It's the value of going to a proper advisor and considering all of the options.
All the options, yeah.
And getting someone else
suits you and your needs is different, because everyone's needs are different.
Yeah. I can tell you what I think is right for you, but you've got to help me by telling me what those options are. And
I will say thanks for going, because I didn't like. Obviously I know, but so you're just talking through a conversation. That thing of the 12 months, so even today, if rates go up on the back of Trump and tariffs, you don't mind, because you've got a year in your security. You can just drop into a fixed rate now. If you really thought the fixed rates were going to go up, you just take one today.
Yeah, or you could take, look, if you look at the trackers of old, people kind of stuck with them. They were told not to give them up, and actually over time they were probably proven right not to give them up.
Well, I don't know, because you were saying, like, if you think, you kind of said earlier on, you think rates are going to get to 2% maybe for lucky. Most trackers are not 0.75. Most of them are 1.25.
Yeah.
So if I was on a tracker today, I'd still be taking the 3.4, knowing I'm secure forever, in my opinion. But that's just me.
Or you could simply take your tracker today, or you
take the tracker yours. Take yours at 0.9. Yeah, it is cheaper, and then decide what to do in 12 months.
The options with us, exactly. Excellent. So fantastic.
Brian Land from Avant, thank you very much for coming to the studio, talking to us. And again, we really appreciate the sponsorship of the show here in Dublin City FM. It's a great partnership. I'm really looking forward to promoting Avant right the way through the show. So thank you.
Thanks, Paul. Thank you very much.